Charge going up, fire in the hole, go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this lesson, we're going to shift gears and talk about something far more important than charts, indicators, or setups, your mindset. Trading psychology is the invisible factor that determines whether you succeed or fail. You can have the best strategy in the world, but if you can't control your emotions, you'll never be consistent. The market doesn't just test your technical skills, it tests your patience, your discipline, and your ability to stay calm under pressure. Let's start with the foundation, discipline. Discipline means following your plan, no matter how you feel in the moment. It means taking only the setups that meet your criteria, risking only what your plan allows, and walking away when conditions aren't right. Most traders lose not because their strategy fails, but because they fail to execute it consistently. You have to think like a professional. Every trade is just one in a long series of outcomes. Your job isn't to win every trade. Your job is to execute your edge with precision over time. Next, let's talk about risk rules, the guardrails that protect you from emotional decisions. The first rule, never risk more than 1 to 2% of your account on a single trade. This means if your account is $5,000, your maximum loss per trade should be $50 to $100. That might sound small, but it's what keeps you alive long enough to learn. The second rule, always use a stop loss, no exceptions. The market doesn't care about your opinions or your feelings. A stop loss protects your capital and allows you to reset with a clear head. The third rule, define your risk to reward ratio before entering. Aim for at least a 1 to 2 ratio, risking $1 to make 2. That way, even if you're right only half the time, you're still profitable in the long run. The fourth rule, avoid revenge trading. Everyone takes losses. It's part of the game. But what destroys accounts is emotional reaction, trying to win it back immediately by doubling your size or forcing trades. When you feel frustrated, step away. No trade is better than a bad trade. The fifth rule, journal everything. After each trading session, record your entries, exits, reasons for taking trades, and how you felt during each one. Over time, this becomes your most valuable data. You'll see patterns in your behavior and identify what truly works for you. Great traders don't just refine strategies, they refine themselves. Now let's address the biggest challenge in trading psychology, accepting uncertainty. Every trade has an unknown outcome. You can analyze perfectly and still lose money. Accepting that truth frees you from emotional attachment. Once you stop trying to be right and start focusing on executing well, trading becomes easier. Remember, trading is a mental game played with financial consequences. You are not your P&L. Your goal is to make good decisions. The profits will follow. The mindset you bring to the market each day should sound like this. I manage risk first. I follow my plan, not my emotions. I focus on process over outcome. If you can do those 3 things consistently, you'll outperform most traders who chase setups but never master themselves. And one more thing, don't let fear of loss paralyze you. Losses are feedback, not failure. They're tuition in the market's classroom. Over time, your consistency will build confidence. Confidence builds patience, and patience builds profit. So remember this, discipline and mindset are your real edge. Charts and indicators only amplify what's already inside you. In the next lesson, we'll move into the practical side again and cover trading platforms and tools, how to set up your charts, use TradingView effectively, and choose the best platform for executing your trades.